Chinese equities will continue to be impacted by sentiment and valuation drivers, despite resilient growth potentials and expected earnings expansions. And we think the near term, the Chinese markets will be range bound and merely driven by sentiment and fund flows. We see the risk of a further derating is limited, but the second half of next year, we see potential re-escalation of geopolitical risk, despite the evaluation levels of disrupted the evaluation levels of Chinese equities. But we highlight some upside catalysts, such as Beijing's policy support to stabilizing China's economy and stimulate growth, and China's decarbonization campaigns and localizations together with industrial upgrading. So there's certainly some downside risks, such as China's macro slowdown and fast tapering and interest rate hikes. But stabilizing growth is the bottom line. And for the next 12 months, growth will be on top of Beijing's agenda towards the Party Congress. Property sector soft landing as a base case scenarios and Sino-US trade talks that may resume in the next 1 to 2 quarters and reach more consensus than disagreement. And we also think that potential spillover risk from quicker than expected Fed tightening will impact Chinese equities less than other emerging markets.
Why would you expect the spillover risk from Fed tightening to be less for Chinese equities rather than other emerging markets?
First of all, you compare the growth rate of Chinese equities to other emerging market stocks. Actually, Chinese equities will contribute more resilient growth potentials. And second, especially for Asia, they're more sensitive to China's policy support as well as spares other than other emerging market stocks. And as we highlighted, we think that the growth will be on the very top of Beijing's agenda. So we think they will do whatever they can to enter growth and to stimulate the growth and find any substantial growth drivers